Live from New York City this morning. Good morning, good morning. For our audience worldwide, we start with this quote right here from John Williams of the New York Fed to Mike McKee. Monetary policy is, quote, in a good place. Going into the Federal Reserve meeting next week and going into some important data this week. Equity futures positive here by 0.5% on the S&P. On the Nasdaq pushing higher as well. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the Federal Reserve going quiet ahead of CPI data. Secretary Yellen feeling good about a soft landing as President Biden weighs in on everything from China to John Wayne.
Good evening, Vietnam, and good morning back in America. Now, let me also speak to significant business we got done in India during the G20 summit. This was an important moment for the United States to demonstrate our global leadership and our commitment to solving the challenges that matter most. Really what this trip was about. It was less about containing China. I don't want to contain China. I just want to make sure we have a relationship with China that is on the up and ups. China has a difficult economic problem right now for a whole range of reasons. There's a movie about John Wayne. He's an Indian scout. And they're trying to get I think there's the Apache, one of the great tribes of America, back on the reservation. The Indian looks at John Wayne and points to the Union soldier and says, he's a lion, dog-faced pony soldier. Well, there's a lot of lion, dog-faced pony soldiers out there about global warming, but not anymore. All of a sudden, they all realize it's a problem. I just think that there are other things on leaders' minds, and they respond to what's needed at the time. But I tell you what, I don't know about you, but I'm going to go to bed.
We're just waking up. President Biden from the G20 over the weekend. Bloomberg's Anne-Marie Hordern will join us shortly to discuss all things Washington, plus investors bracing. The key pieces of economic data this week: U.S. inflation coming up on Wednesday, retail sales on Thursday, setting the stage for the Federal Reserve and its next rate decision just a week away on September 20th. This as Secretary Janet Yellen expresses fresh optimism that the U.S. will be able to contain inflation without major damage to the job market, saying this: every measure of inflation is on the road down. That conversation still ahead with Citigroup's Kristen Bitterly, along with TPW's Jay Poloski. Plus, JP Morgan's David Leibovitz joins us at the opening bell as Apple prepares its big iPhone unveiling tomorrow. This after shares fell by nearly 6% last week. Caught between the crosshairs of the tension between the United States and China. That's going to be a big conversation for us a little bit later, with equity futures positive here going into that opening bell. But first of all, for us this morning, it's September 11th, marking the 26th anniversary of the 9/11 terror attacks that hit New York and Pennsylvania back in 2001. We honor the victims, first responders, and all of those around the world impacted on that very day with a moment of silence in observance of when United Flight 175 struck the South Tower of the World Trade Center.
Darren Christopher Bohan.
Lawrence Francis Balso.
Vincent M. Bolands, Jr.
Tori Hamzavi Bolorchi.
Alan Bondarenko.
Andre Bonhauer, Jr.
This week, we're going to have the CPI data.
CPI.
The CPI print.
We do expect the CPI to come in strong.
The headline is expected to be fairly high.
Driven by energy prices moving higher.
We'll see what happens with the core.
Where does inflation finally go?
What some people are forecasting is a rebound in core inflation.
We are expecting the inflation numbers to continue to come down.
Continuation of the positive trend. A continuation of the drop feels the most likely scenario.
What does the Fed do with that?
Unless you got something very significant on CPI, I think they're not going in September.
This is a very complicated time for the Fed. The question will become the November meeting. Markets should not jump to conclusion too easily as to what's going to happen beyond September. We'll have to see how the data plays out.
Big week coming up. CPI data coming up on Wednesday. Retail sales coming on Thursday. Setting the stage for the Fed and its next rate decision just 1 week later on September 20th. Joining us to discuss is TPW's Jay Pawlowski, Citi's Kristen Bidley. To the both of you, thanks for being with us. Let's start with you, Kristen. Just how hot does CPI need to be later this week to encourage maybe another move from this Federal Reserve?
So I think our expectation right now is that it's going to be in line with market expectations. We know that energy prices have ticked up higher. So provided that we don't see anything outside of what the broader market is expecting, I don't think the Fed's really going to change the trajectory in terms of September. So we think they're going to stay quiet for September, especially given some of the cooling in the labor market that we've seen. But November is really what the market is going to look towards.
Andrew Honhorst and Citi, your colleague, of course, are looking for another hike in November. I'd have to ask this question of you, Jay. If the hawks aren't screaming for a hike this month, are we basically done here?
Yeah, John, I think we are. You put up Fed Governor Williams' comment about monetary policy being in a good place, and we would agree. We're really focused on transitions and what gains traction during times of transition, and we're transitioning in the U.S. and in Europe, we believe, from monetary policy to fiscal policy. And so one of the things we think that has traction is the disinflationary pace, which is taking, which we observe in the United States, Europe, and pretty much globally outside of actually, funnily enough, Japan and China, where inflation is picking up a bit. Both good things in both cases. But to us, we're really not focused on the Fed. We're focused on the traction that fiscal policy gets in the United States. We think that's going to drive a manufacturing rebound, which supports the economy, supports earnings, and supports risk assets.
So, Jay, over the weekend, Torsten Slock of Apollo put out a deck, a load of slides. Great charts in there, showed delinquencies up, bank lending down, perhaps a reason to sit and wait for this slowdown to come through the pipeline, this further tightening to come through the pipeline from the Federal Reserve. Are you saying maybe those long and variable lags aren't so long, they're not that variable? Maybe we've seen them already?
Well, you know, a lot of people, and people I respect, Torsten's one of them, but others as well, talk about the lag reaper and lags and things of this nature. We think the consumer is fine. Household net worth, you know, it just hit a record. Delinquencies are very low relative to history. Credit is not showing any signs of significant problems in the high yield space. Financing last week was a record in the investment grade space. So we're of the view that the economy is going to accelerate. We actually think the Fed is going to double its 2023 GDP forecast next week. And currently, the consensus for U.S. GDP next year is 0.9%. We think that's way too low. And so we expect growth to continue to develop over the course of the coming year. And earnings, again, reflect that, where earnings revisions, another thing that we're very focused on because it drives stock prices. Earnings revisions have moved up. They've inflected higher, and we expect that to support equities.
Jay, I'm going to borrow that phrase and ask it to Kristen. Kristen, is the lagged reaper just around the corner?
So I think what's interesting is that the data here, you can actually find like two very different stories. And I think we've experienced this over the past couple of weeks. So one of the things that we've been looking at is just looking at the personal savings rate. So the personal savings rate right now is around 4.2%. Pre-COVID, that was around 8%. So one of the arguments for a hard landing, for example, is this idea that the personal savings rate and whether or not the consumer has depleted the stimulus that we experienced over the past couple of years, if that has to go from 4.2 to 8, that's going to have a severe impact on the economy. However, I think one of the interesting things is household wealth has massively increased due to the appreciation of home values and also the number of consumers that have locked in historically low mortgages over the past couple of years. And so that would only indicate an uptick from about 4.2% to 6%, which would be much more in favor of a soft landing. So I think you have to look through to all of these nuances and really parse through the data to say whether or not the consumer is strong or not.
I'm having a tough time of passing through the data, Kristen. I've looked at it over the last week or so. I just see tension, conflict, contradictions. I get there's a slowdown beneath the surface in the labour market. Maybe you see that in wage growth. Perhaps you see that in job openings. And then I look at the ISM last week. Fantastic. I look at claims, super low, the lowest since February. Question I asked last week, I'll ask it this week, Kristen. How much weight should I put on one versus the other?
I think this is the argument why, from an investment standpoint, you have to stay very balanced. I think you can make a bull case, for example. The bull case would be one where you say that inflation does continue to come down, that we've seen resiliency in terms of some of this data, that we have seen signs that the labor market is cooling. And I think the most important part is that the recession that many people have been anticipating, maybe we've already seen it from a profit standpoint and what could be viewed as a rolling profits recession, because starting in Q4 of last year, you already had 7 out of 11 sectors in profits recessions. Just in Q2 of this year, you saw 6 out of the 11 sectors in profits recessions. And so I think when you put all of that together, you have a strong stability case. But I think the bear case is one, rates higher for longer. What if inflation is stickier? And so this really requires a lot of patience and a lot of diversification within your portfolio.
Jay, is the outlook for profits getting worse or better?
Much better, John. I mean, it's a fact. It's not an opinion. Earnings revisions have reflected upward. Currently, the consensus for 2024 is about $246, suggesting low double-digit earnings growth. And that's important because valuations, the gain that we've had this year in the S&P has been driven primarily by multiple expansion. Going forward, we need to see that earnings uptick and that earnings come through with that stronger growth as we shift from Fed tightening to fiscal expansion and manufacturing recovery.
Jay, can you say the same thing about multinationals exposed to the slowdown in China, the stagnation in Europe?
Well, one of the things that should help those specific companies, John, is if the Fed is done, as we expect, the dollar rally, which has been pretty strong over the last 8 weeks, up 8 weeks in a row, surprisingly to us anyway, we think that does not gain traction. And therefore, over the coming year, the dollar should weaken relative to the euro. It's at a record low versus the dollar in terms of valuation. Same with the yen. And that will help the multinational companies. And we've done a lot of work of this over the years. And really what drives U.S. companies is what happens in the U.S. Even if they have exposure to other parts of the world, the driver is what goes on in the U.S.
8 weeks of dollar strength into this week. The euro right now stronger against the weaker dollar, on the session at least, at 107.30 going into the ECB on Thursday. Over the weekend, the focus, of course, on the G20 wrapping up in India. World leaders discussing a wide range of topics from climate change to China. This is Secretary Yellen expresses confidence that the US will stick a soft landing, saying this: I think you'd have to say we're on the path that looks exactly like that. Every measure of inflation is on the road down. AMH is with us here in New York City. Anne-Marie, the politician speaking there or the economist?
Well, it does sound like she's looking at the slew of U.S. data. And what that does show is that as inflation is coming down, they are still able to maintain a robust jobs report. And this is really an opportune time for the Biden administration to want to tout this potential soft landing, because, of course, Biden is not just the president right now, but he's looking for re-election next year. So it does seem that we're hearing a more of growing confidence from the administration about sticking that soft landing. Of course, though, Jonathan, Secretary Yellen also talked about the fact that they are monitoring the slowdown and what's going on in China and the potential risks that that might mean to the U.S. or global economy.
Looking for re-election with crude at $87.60 and gasoline prices going in the wrong direction. Anne-Marie, what's the official take from the White House on that now?
Well, it's challenging. And what we did hear from some officials is that they think that what we saw in terms of what Saudi Arabia and Russia did, which was extend those cuts for longer than what was expected, is that they thought the market would stabilize. Of course, the concern is that we're actually past peak driving season in the United States, which was in the summer. So it's very weird that you see gas prices ticking higher. And $4 is what we're nearing towards on the national average. And obviously, that is a huge political problem because every day American consumers will be reminded, because it's right there on the side of the road like an advertisement, that it is expensive to fill up your tank as it is expensive for other items. Inflation is a key concern for Americans, and they continue to give the Biden administration poor remarks when it comes to handling of the economy.
AMH, thank you. On the latest, a wide range of issues over the weekend. Kristen Bidley, crude, close to 90. How does that square with the slowdown narrative in Europe, in China right now?
So when we're looking at what's happened, I think with crude prices, we clearly saw commodity prices jump around 6-7% in Q3, but they're still below their July peaks. And so we would not chase this recent rally in crude oil. A lot of it is more related to some of the policy driven and also demand side driven. And clearly, I would say the major driver of the spike in the price is really what Saudi Arabia and Russia are doing right now. So I don't think that there's a broader macro context here in terms of what is happening in Europe and China. And particularly, I think for anything from an economic perspective for China, what we really need to see is stimulus. And so we need the Chinese government. That's the major catalyst in terms of whether we see that fueling additional rallies within commodities.
Jay, it's not just crude, though, is it? It's a conversation we've had before. It's iron ore as well, at multi-month highs. What do you think's going on here?
Yeah, no, John, we'll take the other side of those comments. We're long commodities. We've been adding to commodities over the course of this year. They've been a significant outperformer relative to bonds, and we expect that to continue. Yes, it is partly supply driven, but it's also demand driven. China oil imports are up sharply. And we think that suggests that the economy is starting to pick up. We're of the belief that one of the things we need to see, we talked about transition and traction. Obviously, the drips and drabs of Chinese policy need to gain traction. We do not expect the big bazooka stimulus. That's highly, highly unlikely. What we do expect is over the next couple of months, the stimulus policies that have been brought to bear over the last couple of months, there have been many of them, but they've been kind of small, will kind of catch traction together and drive the Chinese economy higher. And look, China is still growing at 4.5%, 5%. Manufacturing PMI was 49.7 last month, up 3 months in a row. Trade numbers last week, which everyone bashed, were actually better than expected and up sequentially. So we're of the view that in the coming months, China is going to reflect a better growth path, and that's going to be constructive for those very commodities that you mentioned. And so we have exposure and continue to hold exposure in the energy, industrial metals, as well as other segments of the commodity space.
Jay, look at that, like magic. You managed to say it and the lights stayed on. Last time Jay Pawlowski was bullish on China, the lights went off. Jay, stick with us. We'll talk about China and input costs a little bit later this morning with Jay Pawlowski and Kristen Bidley. Just want to set the stage for you this morning, going into the opening bell about 11 minutes away. Equities with a lift after a week of losses. The S&P 500 higher here by 0.5%. So equity futures pushing higher. Into the bond market, yields look like this, just a little bit higher as well on a 10-year by 2 basis points. The 10-year yield here at 4.28. The 30-year yield higher by 3 basis points to about 4.37. The New York Stock Exchange and the Nasdaq now observing a moment of silence to remember the terror attacks occurring 22 years ago on September 11th, 2001. Equities higher here. Let's get you some morning calls. First up, Morgan Stanley upgrading Tesla to overweight, saying its custom supercomputer could add another $500 billion to its enterprise value. Next up, Bernstein downgrading Brown-Forman to outperform, highlighting the company's improving margins and accelerating growth outlook. And finally, Baird naming Block as one of their top picks, saying shares are oversold after Square's system outage just last week. Final word now from Jay Pawlowski and Kristen Bitterly going into the opening bow 6 minutes away. Kristen, later this week, it really is crunch time for UAW and the Detroit 3. And one question that's dominated this program over the past week is whether that is an example of a hot labour market or just rear view type mirror stuff that we'll leave behind into 2024.
I think it's going to be rear view mirror. I think ultimately when we look at the impact that something like that could have on the overall economy, it's very, very different. And I know there's a lot of comparisons that people are making back to the 1970s when you had unionized labor representing, close to a quarter of all of the U.S. Labor force. Now it's around 8%. And so while that is something that obviously could have an impact, it's something that could lead to stronger wage growth overall. I don't think it's something that is really going to drive a lot of the economic activity and a lot of the market activity into the end of this year.
Jay, which one is it?
Yeah, I would concur with that, John. We're really focused on real income growth, and as inflation comes down, as disinflation takes hold, the consumer is actually generating real income growth, and that's our focus. That is what we believe will sustain consumption and drive a shift from inventory destocking, which is what we've had over the last year, to inventory restocking, and that's what's going to drive the manufacturing rebound we expect to see through the end of this year and into 2024.
Manufacturing up to services and not services down to manufacturing. The bullish outlook from Jay Pawlowski alongside Kristen Bitterly. To the two of you, thank you. To kick off the trading week, 5 minutes away from the opening bell. Equity futures pushing higher here by 5 or 0.6% on the S&P. Into the bond market, yields drifting a little bit higher as well on a 10-year yield higher by, let's call it 2 basis points of 4.28. Coming up, JP Morgan's David Leibovitz joins us on why US equities are poised to outperform the rest of the world. That conversation is coming up next. Your opening bell is just around the corner. 24 seconds away from the opening bow this morning. Good morning to you all. Equity futures pushing forward, up higher, positive by 0.6% on the S&P. On the Nasdaq, up by 0.8%. Looking better this morning. We'll talk about that move in Qualcomm a little bit later in about 5 minutes' time. There's your opening bow. Switch to the board and get to the bond market. Going into CPI later this week. Retail sales later this week as well. That's Wednesday and Thursday, respectively. Yields higher by 2 basis points into that, just short of 430 at 428.60. After 8 consecutive weeks of dollar strength, we pulled back just a touch against the euro. Had a little look at 106 in the past week, 107.35 this morning, positive by 0.3%, and just shy of $88 a barrel on WTI, near the highs of the year, 87.95, positive by 0.5%. About 30 seconds into this session, equities higher by 0.6%, punchy on the Nasdaq. One stock to watch at the open is Tesla. Morgan Stanley upgrading shares to overweight on potential upside from its Dojo supercomputer. The analyst writing this, quote, "The same forces that have driven Amazon Web Services can work at Tesla, opening up new addressable markets." Simone Foxman has the story. Hey, Simone.
Hey, John. Yeah, supercomputer Dojo is being designed to essentially allow massive amounts of data during training processes to be processed by Tesla. And analysts at Morgan Stanley saying it could be worth add as much as $500 billion to the company's market value. Last close, we were at $790 billion worth of market value. So enormous amount of potential value added here. But the Morgan Stanley analyst also writing that it could put Tesla at an asymmetric advantage in a market that's potentially worth $10 trillion. The idea is essentially that it could make the company a software and services company rather than one just simply focused on hardware by allowing this training data to be processed more quickly. Now, this is particularly interesting, however, because just a couple months ago, back in June, these same analysts at Morgan Stanley, led by Adam Jonas, saying that shares were pretty fully valued there around $265, but now putting a new price target, $400 on the stock. Shares, of course, in the moment about $261. Up about 5% in today's early trading. John.
Simone, thank you. That 5% move in the first 2 minutes, that works out roughly $41 billion of extra market cap for that name right there, just like that. Turning to big tech, 2 names for you, Apple, Qualcomm. Apple is extending its agreement with Qualcomm for 3 more years, signalling its own chip isn't ready. The chip maker stating this agreement reinforces Qualcomm's track record of sustained leadership across 5G tech and products. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. The piece of technology is the modem that allows iPhones to connect to 5G networks or prior generations of lower scale network. And this deal runs for iPhone for 2024, 2025 and 2026. You'll remember, John, that Bloomberg's reported that in-house, Apple has been working on its own modem along with its other proprietary silicon strategies. And the story here is that doing it yourself is difficult, particularly when you want your modem to be able to connect to the latest generation network, 5G, but also work across jurisdictions. And, you know, what's interesting going into this Apple event tomorrow, and I think you and I will talk about this later in the program, is that we believe the iPhone 15 that was to be launched tomorrow would be the last generation that used a Qualcomm modem chipset. Well, based on the agreement that's out this morning, that is not the case, and Qualcomm will be the modem supplier for the next 3 years and 3 generations of iPhone to come. Financial terms were not disclosed, although it was indicated by Qualcomm that the agreement in terms of dollar volume or dollar amount is the same as their prior 2019 agreement. You and I have talked about what drives an upgrade cycle. We used to talk about the 5G super cycle. One thing that analysts point to is that this is pretty bullish for Qualcomm, bearing in mind that it won't be that long before we talk about the 6G super cycle and what that might mean to keep Qualcomm in this position as the pivotal supplier to Apple.
You know, we're discussing this in about 10 minutes' time. You also know that I want your view on that last story. Adam Jonas, that call over at Morgan Stanley. And I know you've read that. What did you make of it?
Yeah, look, it's really interesting because Adam Jonas first came out with this thesis in 2015, right? That the long term of Tesla would be very different to just being an electric vehicle maker. He saw them as offering a service akin to an Uber or a Lyft, a rideshare service where Tesla controlled its own fleet of vehicles and the proprietary software. Fast forward to 2023, and that's not quite reality. But in all the conversations around NVIDIA and them having the leading GPU for AI and training large language models, we were talking about Dojo in the context of training data, neural networks before NVIDIA. It's an area that Tesla has some competence in. They've pledged to invest about $1 billion in R&D to continue doing that. And you know, the point that Jonas is making is that it opens up more end-user use cases, the ability to sell software services at a greater scale. So 2 things. Caution on Adam Jonas's history of making big predictions, but also credit to Tesla in the work they've done in proprietary silicon and in computing.
Helping to lift this market as well. Tesla up by 5% or so. Ed, thank you. Big move on the Nasdaq, up by close to 1%. On the S&P 500, up by 0.75%. That move on Tesla, potentially the best move of the month so far for Tesla. Sticking with tech, Citi expecting shares of Microsoft to outperform, saying this: the stock could trade well into earnings with a stabilizing PC market and accelerating revenue trends. That stock up also by 1%. Some big calls out there for tech. I want to turn to M&A. JM Smucker agreeing to acquire Hostess Brands for $5.6 billion US. The Hostess CEO saying this: we believe this is the right partnership to accelerate growth and create meaningful value for consumers, customers and shareholders. Isabel Lee has this one. Hey, Isabel.
Hey, John. So investors will get $34.25 for each Hostess share, and that's a 22% premium from Friday's close. And shares of Hostess, which is the Twinkies maker, have surged more than 26% since before August 25, and that's the day that Reuters first reported that they're exploring a sale. So company sees the deal adding to an adjusted EPS in the first fiscal quarter, and they expect it to close in the third fiscal quarter. So that's around April 2024. So Bloomberg Intelligence says this acquisition may revive growth in the consumer division, and bakery goods have soared during the pandemic, and Hostess holds around 19% of that market share. As for Smucker's, it's fallen around some 11% year to date. But here's one thing I learned, John. Smucker was founded in some 126 years ago by Jerome Monroe Smucker, selling cider and apple butter door to door in his horse-drawn wagon. And now it's a $14.5 billion company. For now, those shares are lower by around 8%, while Hostess is up around 19%.
And now they're getting a piece of snacks that have no expiry date. Is that right?
Probably. I actually don't eat that a lot.
Extra long shelf life, like 20, 30, something like that. Isabel, thank you. The latest there on that story. I want to turn to the media space. One question. Bills Jets. Can you even watch it tonight? The contract dispute between Disney and Charter could leave New Yorkers in the dark for tonight's game when the Jets take on the Buffalo Bills. New York Governor Kathy Hochul, and Bills supporter, is pursuing repayments for subscribers, saying this: it's simple. If you pay your cable bill, you deserve to get the services you pay for. Abby has more. Hey, Abby.
Hey, John. Well, that does seem like a reasonable proposal by Governor Kathy Hochul, although I'd almost be willing to bet that she might no longer be in office by the time that made its way through Albany. Now, putting all of that aside, of course, we're talking about a financial feud between Charter Communications and Disney. On August 31st, Disney pulled ABC, ESPN, and some of its other channels from Charter, which owns Spectrum. So you have 15 million people across the country that are not going to be able to watch the Jets' opening season game. Now, in normal seasons, this might not mean all that much. We all know, even I as a non-football person knows, that the Jets is pretty beleaguered. They have not been in the playoffs since 2010. That's the longest drought for any team in any major sport here in the USA. But we have Aaron Rodgers joining the team, so everybody wants to see this game. So you have folks, especially here in New York State, 1.5 million people who may not be able to watch this game. Now, of course, they can sign up for other streaming services. Bars here in New York are really excited for the business as folks come in to see this game. But you have this financial feud again, where Spectrum is claiming it offered Disney a fair deal to carry its channels, but Disney demanded an excessive increase in price. There's no end to the blackout on the year, John. Disney down 6.1%, Charter up 25%. This, of course, as Disney works to go through some of the kinks, including its struggling TV business.
Abby, thank you. If New York sports was a stock right now, it would not be doing well at all. About 9 minutes into the session, equities positive by 0.6% on the S&P. JP Morgan's David Leibovitz weighing in on the road ahead for markets and writing this: growth is proving to be resilient against the backdrop of significant monetary tightening, suggesting that a tension between growth and inflation is beginning to materialize. David joins us now for more. David, can we start there? Can you start on that tension between growth and inflation? What do you mean by that?
Absolutely. So, if we go back to the beginning of this year, everybody thought that the second half of 2023 was going to be particularly challenging from an economic perspective. And what we've seen in the event is simply more resilience in the growth data, and that's continued throughout the third quarter, which obviously makes it difficult for inflation to return to where the Fed would like it to be. I oftentimes think about inflation as being like economic sweat, right? You end up with inflation when you're running an economy above its trend rate of growth. We estimate trend in the United States is somewhere right around 2%. And so the 2% plus growth that we've seen this year, we believe is going to make it a little bit more challenging for inflation to get back to where the Fed would like it to be.
What's the stubborn inflation trade then, David? Where do I want to be?
So I continue to think that the Fed will stay higher for longer, and so we continue to see opportunity in shorter duration fixed income. On the equity side, we think you want to lean into value, right? These are more cyclical companies. They tend to be more sensitive to the overall pace of growth, and so we want to take advantage of that window while it remains open.
Do they leave me exposed to the international story if I was trying to avoid the slowdown in China, the stagnation in Europe? How would I go about doing that?
Sure. So, I think value is interesting in the sense that, on the one hand, you have things like energy and financials. On the other hand, you have things like utilities and consumer staples. And so we would be leaning a bit more into the defensive parts of the value complex. But as you and I chatted about, I think last week, with energy prices at $90 a barrel or oil prices at $90 a barrel, there's arguably a story there as well. And so it's more about picking and choosing within value as opposed to embracing the style as a whole.
David, on crude, and you're right, we did talk about this last week. Let's do it again. What do you think that speaks to? 91 Brent, 88 WTI.
So I think at the end of the day, there's an issue on the supply side and an issue on the demand side as well. We're seeing, if we start with demand, we're seeing growth in places like Europe and China obviously come under pressure. But, here in the United States, things are still progressing relatively nicely. And so while pockets of demand may be rolling over, we're not seeing demand in general or in its entirety begin to show material signs of weakness. At the same time, you have limited supply. And I think that that's really been the story as of late. Right, with OPEC and other oil-producing nations cutting back on the amount of oil that they're supplying to the overall market, that's pushed prices up to levels that haven't been seen in quite some time. And we can't forget about the United States, right? We obviously generate more oil here, produce more oil here than has been the case in the past. But do we produce the right type of oil? And that's why I think you're seeing diesel prices in particular move aggressively higher.
That's a great point. Close to record output. The latest number, 12.8 million barrels a day in the United States, getting closer and closer to 13. David, when we put it all together, what's the preference at the moment? Domestic, US or international?
So we would be leaning more into the U.S. relative to the rest of the world. When we look at what's happening in China, and it kind of feels like policymakers may have their hands tied in terms of stimulating that economy in a more effective way. You look at Europe, cracks are beginning to form. Inflation is stubborn, but growth is in the process of decelerating. And so, the U.S., it's not perfect, but arguably it's the best house on the worst block. That's where we would prefer to hang our hat. And within the United States, we do have a preference for large caps relative to small caps. We do think that volatility is going to pick up here as we get closer to the end of the year.
And some of these great brands just caught in a rock and a hard place at the moment, between a rock and a hard place. I'm thinking of Apple. I know you can't speak directly to that kind of name, but David, the exposure to China at the moment, what kind of exposure are you and the team looking to take?
So when it comes to the China story and the underlying exposures, I think that there are two ways to think about that aspect. One is the exposure on the supply side, right? Does a certain business make a lot of things in China? Two is exposure on the demand side. How much of a market does China represent? And as we've seen with some large technology companies as of late, the demand side is real. And so I think we need to be tuned in, particularly to regulatory risk going forward, because if I was a betting man, my best guess would be that we haven't seen the end of the trend that's kicked off here as of late.
I think most people sitting at home nodding their head agreeing with you. David, thank you, sir. David Leibovitz there of JP Morgan. Speaking to some of the tensions around the story with Apple over the last week, that stock down last week by close to 6%. Coming up, Apple preparing to launch its next iPhone.
What continues to come out of Cupertino is the gold standard. This is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
That conversation up next.
They've gained an incremental 125 million users over the last 2 years. 250 million iPhones have not been upgraded in 4+ years. And if you look at this special chip camera technology and what continues to come out of Cupertino is the gold standard. And that's why I believe, especially with a lot of big carrier discounts, this is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
They came out of hibernation big time in the last week or so. Dan Ives of Wedbush reiterating his bull case for Apple ahead of tomorrow's big launch event. The company preparing to roll out the iPhone 15 along with their newest smartwatches and AirPods. This coming as Apple extends an agreement to get modem semiconductors from Qualcomm for 3 more years, a sign that its effort to design the chips in-house is taking longer than expected. Ed comes back with us for a little bit more. Ed, big day tomorrow. A lot of weight on the shoulders of Mr. Cook going into this launch.
Yeah, and you and I won't know if this is a mini upgrade cycle until after the fact. But what we're expecting is 4 variants of the iPhone 15. 2 base models, the 15 and 15 Plus, 2 Pro models, the Pro and Pro Max. And as Dan Ives was talking about, a big focus on the Pro lines, on the silicon updates and the camera technology. So on the iPhone 15 Pro and Pro Max, we expect Apple's A17 processor, its latest generation processor, along with a U2 UWB chip, RF chip for short distance connectivity. On the camera side, we're expecting not just software upgrades, but also optical hardware upgrades, particularly on the Pro Max, that will take it from a 2x zoom to a 6x zoom. These are substantive hardware upgrades that we haven't seen in recent refresh cycles. On the design side, titanium sides to the Pro line, as opposed to aluminum or steel, a sort of higher quality but lower weight product. And then again, updates to iOS, along with some kind of more minor updates to the Apple Watch series, and then USB-C connection coming to the AirPods. The timing of this Qualcomm announcement this morning really interesting, because we believe that the iPhone 15 lines to be announced tomorrow would be the last generation that Apple relied on Qualcomm's modem. That's clearly not the case. This deal between the two runs through to the 2026 edition of iPhone. And as you said, it's evidence that making it yourself is hard. Apple isn't quite there with its internal work on the modem. Qualcomm has the best chip at connecting to 5G networks, and it won't be long before we're talking about 6G networks. Just real quick, John, on silicon, the base models of iPhone 15 and 15 Plus, they'll have the A16 processor, which was in the 14 Pro lines. So they're just recycling their tech from those Pro last year and moving them to the base model this year. Gosh, that's a lot.
Speaking of challenges, just away from all that jargon, just for a moment, the 2 big challenges in the past week: 1, Huawei; 2, China, and China specifically banning phones at the government level and maybe across the state firms as well. Ed, what do you think is the bigger issue for that company at the moment?
Yeah, look, I still go back to what Apple told us in the earnings call, and I'm surprised that more people aren't speaking about this. China was a pocket of strength in a broad, weak quarter for Apple in the June quarter. It was a record in China in the June quarter. They swung to 8% top-line growth in China from a 3% decline the prior quarter. And they attributed it almost solely to switchers, consumers in China buying an iPhone for the first time or switching from a non-iPhone or non-Apple brand. So my question to the market is, does this Chinese government action impact the psychology of the consumer there such that it outweighs the hardware upgrades that are coming in 15? It's still such a key market. So the impact, we don't know what it will be because we can't quantify how many users are sprinkled across these government agencies. But it's worth asking the question.
I'm asking precisely the same thing. Ed, thanks for being with us, mate. We'll catch up with you tomorrow. Let's stick with tech. Oracle earnings coming after the closing bell. Investors focused on whether its cloud unit can continue gaining market share. The analyst over at Mizuho had this to say: despite the uncertain macro, demand for back office applications remains robust. Anurag Rana of Bloomberg Intelligence joins us now for more. Anurag, what can we expect a little bit later?
Yeah, I think we should expect decent growth on the back office cloud applications. But to be very honest, the biggest question is what is going to be the cloud infrastructure growth, because that's the big number that surprised everybody last quarter. It grew 77% in constant currency. And that's where I think the bulk of the call is going to be around that particular product and how it's gaining momentum in an area where Amazon and Microsoft are, the growths have been slowing down in the last 12 months.
We'll get your reaction a little bit later today. Anurag, thank you. That stock is down by a little more than 1%. Those earnings coming after the close. About 22 minutes into the session, equities advancing here by 0.4% with some sector price action. Here's Abby.
And that gain for the S&P 500, John, is the best day in the month of September. Right now, not surprisingly, we have most sectors higher, led by consumer discretionary up 1.6%. Tesla is greater than 5% gain on that Morgan Stanley call, really helping out there. Tech overall, though, down slightly. Industrials also down. Over the last couple of months, John, in fact, in this quarter, one of the best sectors, energy. It's heading to its only up sector this year, and the best sector since December of last year, up 12%. Really a turnaround there.
There we go. Abby, thank you. Coming up next, your trading diary, stacked week just around the corner. So far, so good. Early days, I know. 25 minutes into the session, equities advancing here by 0.5% on the S&P. The Nasdaq looking okay as well, going into a key week again for Apple, and that launch of the iPhone 15 just around the corner. That's the equity price action. Here's the trading diary. Coming up, President Biden delivering remarks in observance of 9/11. That's at 4:45 Eastern from Alaska. Tuesday, Apple's launch event from Cupertino, California. Wednesday, we'll get US CPI data. Thursday, initial jobless claims, US retail sales, and an ECB rate decision. And finally, the UAW strike deadline with Detroit's Big Three. Big week ahead. From New York City, this was the Countdown to the Open. Thank you for choosing Bloomberg TV. This is Bloomberg.